All right, so I think I got a pretty good update for you guys tonight. Obviously, a pretty brutal sell off today. A lot of talk about yield curve inversion and recession and so forth. Um, Not sure the last time I posted an update. I think the last time I posted was probably either over the weekend or on Monday. We saw a pretty brutal sell-off on Monday as well. We're back to the SPX here, by the way, is the chart we're going to start with. Again, this is generally our benchmark chart. We're always going to use this as kind of our touch point. You'll notice I used to have the vertical line here September 1st for tariffs. Of course, that's no longer an issue, so that's come off. That's what led to the big rally yesterday on Tuesday. And by the way, just as an aside, I was joking with a friend of mine because we were talking about just the cyclicality of the markets. And one of the things, I think I've said this before to you guys, the markets, they've got their own personality, and you want to spend a lot of time watching the market so you can get a sense of the personality. And one of the little quirks that you'll notice when there's a brutal sell-off on a Monday, you'll see this was last Monday's sell-off. We closed just below the lows on that from that sell-off on Monday. It's not uncommon. In fact, more likely than not, you'll see a rally the following day, which would be the Tuesday. They call it turnaround Tuesday. It's not just clever alliteration. It's actually a quantifiable kind of market trend to see a Tuesday rally subsequent to a pretty brutal Monday sell-off. But you can see we closed a little bit lower than we did that last Monday. But nonetheless, brutal sell-off today for the S&P. This is about an 85-point sell-off today. Still above the 200-day moving average for sure. As you guys will remember from previous videos, I've talked about the potential downside risk of potentially getting to about 27.95, which is the 200-day moving average. There's a chance we'll kiss off that. If we do breach that, 27.25 is the next level, which we've got down here. So that's and again, one-day charts here to keep in mind. So something to think about. Now, obviously, what drove today was this yield curve situation. So let me just quickly talk about this. So first of all, what does it mean, the yield curve inverting? What it means is that the short-term U.S. Treasuries, so this is like 2s, 3s, 5s, the yield, in other words, the payout you get for owning them has begun to eclipse some of the longer-term bonds, in this case 10 years. Now, you'll remember me talking maybe through Twitter when I've posted about the 10-year back in November, October last year when, in fact, I'll just look at the chart on the 10-year. You'll see we're precipitous sell-off here, well below the 200-day moving average. But back here is like November, October 2018, when we were breaching 325 on the yield and the 10-year, people were freaked out about inflationary pressure and, oh my God, the Fed's going to have to increase rates, which obviously would be bad for risk assets and bad for U.S. equities. So we're on the whole fucking opposite end of the spectrum now, down here, with this inversion. So, is it a accurate gauge of potential future recession? Yes, it is. But I think the important thing to realize when you look at today's session, a couple hours before we opened, I think literally got like 2 basis points below zero, and the 10s minus 2. So if you took the 10-year yield, subtract the 2-year yield, if that inverts and gets below zero, it's not a good thing, right? And that's the whole issue with today's sell-off. But normally when people freak out about that, it's a sustained price level that's below that 10s and 2s at the zero level, and it's usually a sustained thing for a couple of days, and it's generally more substantial, 10, 15, 20, 25 basis points. We're talking about 2 basis points that lasted maybe a couple hours before it's recorrected. I think we're roughly around 5 or 6 basis points above zero now, so we're no longer inverted. We were only inverted for a short period of time. So I just think the freak out today was a little bit kind of over exaggerated. I saw it on social media. And again, I've said this before too. I mean, you got to take politics out of this stuff. I'm as political as anybody, right? I'm very critical of the president. I'm really upset with the trade war, etc. But you can't take any one data point and try to politicize it, because it's just not a smart way to trade. and you're going to get yourself into trouble. So I just wanted to point out that, yes, the yield curve inverted today. It did so for a very short period of time. We'll have to wait and see how the markets play out in this instance, but nothing to seriously freak out about in terms of recession. Again, as a forward-looking instrument, these are generally predicting 12 to 22 months into the future. But again, usually it's a sustained level that's well below zero with regard to 10s minus 2s, and we're not seeing that yet. Now, the yield curve's been flattening for a long period of time, as I just showed you on the 10-year here. This is a several months long trend, several weeks long trend. So it's concerning for sure, but not a reason to sell the farm. I think the bull case is still intact. So again, going back to S&P here, I'm looking at, again, downside risk, looking at this level at the 200-day. Hopefully price targets more up here, closer to 29.95 or breaking in 3,000 to the upside. The one thing that did concern me today was Dow Jones. I normally don't look at Dow Jones, but because Dow Jones broke a key technical level today, I thought I'd touch on it. This is the Dow Jones chart, again, one-day candle chart. You can see we broke below that 200-day moving average and actually closed below it. This is what you call a heavy close. We closed right on the lows. So you don't see a wick down here, right? We've talked about the wicks. There's no wick down here. We closed at the lows, which is generally a little bit scary. So I'm going to be watching futures overnight. Would certainly prefer to see us have closed above this 200-day. So watching the Dow Jones pretty closely. So that's kind of the macro stuff. Again, don't freak out too much about this yield curve stuff. Let's just keep watching and see what happens. I mean, again, it was only, just a few months ago that we were worried about, elevated levels on the 10-year and concerned about the Fed taking rates up. Now we're talking about, obviously, the Fed bringing rates down. They just cut 25 basis points in July for the first time in 10 years. So let's reserve judgment on that one. I wouldn't be trading on that data point personally. But again, the whole point of this video is to try to hit specific names, and I do want to get back to ZEN, right? So this was a name that I touched on last week, and I want to hit it again. Oh, one more thing I want to mention on the SPX and the Dow. Really low volume today as well, and when there's low volume, you can see some pretty drastic price swings, and so low volume is a little bit seasonal in the markets. July and August are generally low volume markets because there's a lot of people on vacation and so forth. So there were not a lot of shares transacted as there normally would be today, and that can create some pretty substantial price swings because what happens is bid and ask spreads get exaggerated, and so when there's pressure one way or the other, whether it's the upside or the downside, you can see prices swing far more drastically. It's the same principle as to why you see price swings pre-market as well as after hours, because there's fewer shares being transacted. And that's why you always use limit orders when you're buying or selling in those trading hours, whether it's pre-market or after hours. I always use them during market hours as well. So just a little bit of a tip there. But anyway, that just speaks more to why there was such a drastic price swing today. It wasn't just because of the bonds. It's also lower volume, which I think is important to note. But anyway, going back to specific names, I wanted to get back on this ZEN because to me this is a beautiful setup and just a perfect setup, particularly for newer traders that just want to, again, get your feet wet, get some confidence. I put the trend line in here to show you off the lows, like kind of where we're headed. To me, 95 is the price target. And for me, again, I touched on this 200-day moving average as kind of an inflection point. And to me, that's pretty much held as we zoom in here. But we've seen all this market noise, right? On Monday, we had the China trade issue. On Tuesday, we saw the nice rally as a result of the tariffs coming off the table. And then today, we got the hell beat out of us based on the yield curve inversion. Now, you'll see the nice long tail down here, right? So there was a lot of buyers that stepped in. And again, this 200-day moving average, to me, is exactly why we saw these buyers step in. So to me, this, despite the noise and the stochastic nature of the last few trading sessions, this is still a beautiful setup. And for me, it's a great way, particularly for newer traders that want to step in and, just like I said, get a solid trade under your belt, monetize this potential upswing. Could we go lower? For sure. Could we chop sideways? For sure. But I think the probability here is to the upside. I think 95 is your price target. If you're not going long on stock, you don't want to buy the stock, you can always trade options. I'd go well out into November, December if that's the case. But really beautiful setup here on Zen, so I just wanted to touch on that as well. I think that's it for this particular video. If you guys got any names you want me to touch on, whether, we talked Bitcoin as well, I'll touch on crypto. If you want to touch, fixed income bond yields, whatever you really want to chat about, I'm happy to chart it out and do some coverage on it. So anyway, we'll leave it at that. Happy trading, and let's see what happens for the close of the week. By the way, keep in mind, Friday is an options expiration Friday. So generally what that can result in is generally just a little bit of amplification or exaggeration to the upside or downside with regard to options expiration. If the market's moving higher, you might see it kind of get amplified to the upside. Selling, same thing, just vice versa. Problem is on Fridays, obviously there's some traders that just don't have the risk appetite to hold through the weekend. So sometimes Fridays can see some of those heavy closes like what we saw today in the Dow that I pointed out earlier. Anyway, that's it. I'll hit you guys up probably back over the weekend. Until then, happy trading, and we'll catch up this weekend.